Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Thomas Schickler, CEO of Liquidity Marketplace, on the show with me today. Thomas, welcome to the show.
Thank you very much for having me, Michael.
Glad you're here. All right, now, why would you leave a senior role in banking to set up a startup?
I had a senior role in banking, and one of the areas for which I was responsible was helping HSBC formulate its response to Basel III related regulations. And I could see a clear problem emerging, one for the bank in terms of the capital costs associated with both institutional deposit taking and short-term lending for institutions. And I could see a problem for our clients in that if our capacity declined, where were they going to deploy their cash and where were they going to source their short-term cash? And when I looked out in the kind of emerging space, both fintechs as well as new developments from a market perspective, I couldn't see a solution. And I had an idea around how to solve for it. And so I guess in all my roles in banking, I always saw myself as an entrepreneur. It wasn't that big a leap to say, why not become an entrepreneur? Now, I may not have anticipated all of the wonderful challenges of being an entrepreneur, but certainly I felt inspired enough to bring a solution to the market that would be complementary to banks and actually serve a true client need. So this is client need driven, not necessarily technologically driven.
Let's, if we may, open that up and drill down a little
Sure.
bit onto the problem that you are solving.
Sure. So following the financial crisis, regulators were quite keen to prevent a replay of the Lehman scenario. So for those who are not familiar with why Lehman struggled, they were funded from very short-term liquidity, money markets. And so when that was no longer available, they effectively had a heart attack and went under. And that's an important thing when we talk in a few minutes about the borrowing and lending directly between corporates. Banks die of heart attacks, corporates die of cancer. And so in the short-term liquidity space, that's an important thing to remember. So what did regulators do? Well, they really changed the way banks can rely on institutional deposits. And for any institutional lending, they pushed out the duration. The implications are pretty significant from a capital cost perspective. And that's why you would have seen banks like JP Morgan a few years ago. Jamie Dimon came out and said he was going to shed over $350 billion in institutional deposits. Similarly, when I was at HSBC, Stuart Gulliver came out and said we were going to shed $120 billion. And actually that task fell to me to execute. And on the flip side, we were cutting back similarly on revolving credit facilities and pushing up the cost thereof. So there's a real problem out there. And if you layer on top of that the money market fund reform, which took place in the US in 2 years ago, and which is coming to Europe, what you saw in the US was an outflow of over $3 trillion from the money fund industry. So, it's a real challenge for corporates and non-bank financials to find a place to deploy their cash. And when they do need short-term cash, to source it at a reasonable yield.
Now, I want you to open up the liquidity markets for Fortune 1000 companies because it's changing. So we've got multinational and corporates, and what's going on with them?
Well, what's going on for them is they need alternatives. The whole thing around managing liquidity is having arrows in your quiver. So if you look at it from a deployment perspective, like they have excess cash, what are the options? They could leave it on deposit, but as I mentioned, especially the systemically important financial institutions are very sensitive to how much they leave. And you know what that means? Banks actually charge fees for deposits. So imagine effectively the corporate is lending the bank money and the bank is actually charging them for the service, which is, it's hard to fathom.
Yeah.
Then, so, one deposit is one avenue. Money market funds, as I mentioned, are less attractive. Before it had a stable NAV, which gave the imprimatur of principal protection. That's gone. Now it's a floating NAV. So that makes the money market funds, which don't necessarily generate significant yields, but less attractive, because not only do they not generate a big yield, but the principal's not protected. So then, for the corporate treasurer, or even the treasurer of a non-bank financial, they have to go a bit further afield to get an appropriate risk-weighted return on their investment. On the flip side, for corporates who need to borrow in short term, access to revolving credit facilities is declining, and when they do hit them, they're charged very significantly. And the other alternative is really issuance of commercial paper. But if you're going to issue commercial paper, you got to pay the rating agency to rate the paper. You got to pay the broker dealer for a facility fee. You got to pay the broker dealer for the bid offer on the issuance, et cetera. So there's a lot of cost associated with it. So there is a clear market need, and that's what we bring to the table.
It sounds like you've explained the institutional clients' reasoning for joining the liquidity marketplace platform. Is there more to it that you want to bring out in today's interview?
Sure. Well, I think it's the economics are clearly the driver behind it. Mm-hmm. And that's one part. But the second part is expanding the range of counterparties to which they have access.
There you go.
Historically, this market has been completely intermediated, primarily by banks and to an extent, the fund managers. And so when you have a greater range of counterparties, your overall risk is improved. Your risk exposure is improved. And so on the one hand, you've got an economic opportunity. And then on the other hand, I guess you could look at it from an overall risk-weighted return. Your risk dynamics have improved. And both are important.
Tell me about your competitors, how you stack up with them and what makes you different.
Sure. Principally, we would look at competition along two dimensions. There are portals out there which enable multinational corporates and non-bank financials to deploy cash. And those typically are more like channels. They help the corporate deploy cash into existing asset classes or solutions. So be it time deposits with banks or money funds. However, those portals developed principally to support either money fund investment or foreign exchange. So they're not really starting with the view of how do we solve for the liquidity need. And importantly, what those portals only do is effectively connect corporates to both banks and money funds. They don't connect corporates to other corporates to borrow and lend directly. And that is something that we are doing uniquely, and in a way in which nothing changes from trade to trade except for the discount rate and the counterparty and the duration. Everything that the execution is based upon a common set of terms and conditions to which all the participants accede when they join the marketplace. And that's really game-changing and different. We're enabling people to connect with each other and trade with each other who previously could never have done so without a massive army of legal counsel.
That is a big difference. Let's look ahead 5 years and tell me what you see the market looking like.
Sure. Well, first of all, we're launching for our marketplace first in the US, and then we expect to expand geographically next to Europe. And actually, we've also started some activity in Asia, and we expect to expand across Asia. So what we really look to see is companies being able to source and deploy funding, both in the unsecured loan instrument, which we've now created, as well as across an additional range of asset classes, which we expect to launch over the coming years. So, we will leverage blockchain to offer secured borrowing and lending. We will also push into other asset classes, prospectively repo, et cetera. So it's really an expansion of geography and asset classes.
Brilliant. I really enjoyed the conversation. I think that you're going to be bringing not only to our portfolio of companies that come through our show, but to the entire world, a new way to solve an issue that I can see is either going to give somebody cancer or a heart attack. Well put. Thanks for being a guest, Thomas.
Thank you for having me. Appreciate it.
My pleasure. You've been watching CEO Money with Michael Yorba. Thanks for joining us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.